All righty. Well, I do show that we are fully at 12:01, so let's go ahead and kick this off. My name is Christina Strickland. I'm one of the advisors here at Infinitas, and a couple of housekeeping things before we get into our presentation. Zach DeSetti, David Pacer, and Bruce Glenn will be speaking with us today about where we've been so far this year in the markets, what we can anticipate moving forward, and then how to react to that as individual investors. The housekeeping notes very quickly. This session is being recorded. So once it has been completed and compliance approved, it will be available online for individuals to watch or listen to it at a later date if they'd like to. If you would like to ask a question, you have two ways that you can do that. You can simply unmute yourself in Zoom and ask the question out loud, or you can email it to me, which is Christina with a K at infinitas.kc.com. If you don't want to ask out loud in front of everyone, feel free to email me the question, and I will be monitoring my inbox for those questions as we proceed throughout the presentation. Also, if you are in an area where you have a lot of background noise, please go ahead and mute yourself so as not to distract the speakers and everyone else listening. You can simply mute or unmute yourself in the bottom left hand of your computer screen. And so with that, I'm going to ask David and Zach to kick us off with where we've been so far this year. I know a lot of folks have lots of questions about what's going on in their portfolios and what's going on in the markets. So if you two want to kick us off with that, that would be fantastic.
Great, thanks, Christina, for that. And yeah, I mean, looking back, so far year to date, I think everyone's pretty in tune that we're struggling a little bit in the markets this year, and looking back gives us a great idea, where we've been, and probably some guidance and tells a story and gives us some guidance on where we are, and maybe what we should do going forward. So throughout today's presentation, I think we're going to definitely try and highlight some of the trends that we've seen in the past, where we think we're going to go year to date, and then maybe give some insight as to how you can act upon that. But I'll start real quick. As most people are pretty familiar with, whether we're watching the news or things like that, we've seen, as we've referred to, the overall market being down this year. But I want to break that out, I guess, a little bit into what the market is. And it really depends on what segment we look at. We're all pretty familiar with the S&P 500, which, as of this morning, I saw is down just a little bit over 18%. The Dow Jones Industrial Average is another index that's used commonly. That's down about a little over 13%. And then the NASDAQ composite is down about 26%. So there's obviously a little bit of a range and some disparity between those three indexes. Remember, the S&P 500 is probably one of the more broadly used indexes because it covers multiple different segments of the market. It's really composed of the top 500 largest companies in the U.S. So it's a pretty good indicator of what's going on in the economy today. The Dow Jones is made up of about 30 of our larger blue chip companies. So when I say blue chip, it's really larger, more recognized companies, a little bit more high quality. That probably being really the biggest factor why that index is not down, maybe as far as some of the others. And then the NASDAQ, that's, like I said, that's down about 26% year to date. That's composed of mostly technology stocks. Over the last really 2 years, we've seen the biggest trend upwards, the biggest growth in that index. So it's maybe not as much of a surprise that with that growth, given this year, that it's giving back some of those gains. So I think it's really important to know when we look at the market, overall, when we hear on the news, the market is down X. Well, it's really not as simple as just looking and hearing about that on the news and saying, okay, yes, my portfolio is down 26%. Okay, we really know that your portfolio is made up of multiple different segments. So we really try and pay attention to which part that's in. David, did you have anything to kind of add to that on where we sit, year to date so far?
Yeah, it's funny. We all try to figure out why the market's doing what it's doing. And we don't know all the answers, but some of the things we do know for sure, like Zach said, the market's down. And there's so many different markets to track, but we finally hit a bottom on the S&P on June 16th. It hit negative 24%. Well, prolonged decline of prices over 20% is a bear market. So I would tell you, we've already hit that bear market opportunity. And I say opportunity because I feel we all need to look at this as an opportunity. But what people are worried about right now are all the same. It's inflation. Right? Things are expensive. Inflation's over 8% right now across all different industries. We've had 3 interest rate hikes, right? We had a 1/4 basis point in March. We had a 50 basis point in May. We had a 75 basis point increase in June, and now we're slated for what looks to be another 75 basis points. So things are getting expensive. Interest rates are going up. The war on top of everything just kind of put icing on the cake to bring more fears in people's minds. And we're in a midterm election year, which always historically has been choppy. You know, we went into this year with the market being the highest it's ever been in the history of the world, right? At the end of 2021, we hit that new high, and it was up 100% since COVID at the bottom and just a year and a half ago. So a lot of things are happening, but I think we need to use this as an opportunity and look at the basic fundamentals. We're not in a recession yet, right? A recession is defined as negative GDP over 2 quarters. We're going to find out here next month if the second quarter truly brought negative GDP, which I would tell you it's probably going to be. So we can say we're leading into a recession, but what does that mean overall, right? The economy is still strong. I mean, Zach, if you pull up that slide, we can give people kind of a visual. Right, I don't know about everybody else, but I go to the stores, the restaurants, people are spending money like they never have before. And this illustration here kind of shows going back 147 years. You look across the bottom, and this is the S&P 500. So you look across the bottom, and we're in that negative, we've reached that negative 20 to negative 30 area on this chart, which is 3% of that 147-year time period. There's only been 3% of other years that were negative more than where we are now. So I would tell you, we're breaching some pretty low bottoms here pretty quickly. And where does the market go from here? Well, every time the market goes down, it's gone up higher than it's ever done before. So we're trying to convince people and tell you not to panic. You really need to use the basic fundamentals and not panic and not make rash decisions.
Well, I think David and Zach, you're full of rays of sunshine today. But I think it's funny that you mentioned, David, about remembering and don't panic. And it's ironic because I think as investors, we remember the 80s when interest rates were insane. We remember the dot-com bubble. We remember the 2008 housing market crash. We remember the summer of 2015 when gas prices were crazy then. We remember COVID, obviously, but I think for some people it just feels different now because there's so many different things going on with, you talk about the war and inflation and a midterm election, and it just feels different. But, something I think that most people would agree is it feels different every time,
Yeah. Well, I think this time around too, which, we definitely don't want to gloss over, is that we've had a pullback. Usually when equities are down, we rely on fixed income in our portfolios to provide a little bit of a cushion. And just like David mentioned, with interest rates and inflation and all that, that's brought down the price of fixed income in general too. So we kind of have, both segments of the market as far as equities and fixed income, we're fighting against this year too. So, maybe that provides a little bit to your point, Christina, about it feels a little bit different because it's like, we get questions from clients. It's like, what do we do? Where do we go? We can't hold stocks. We can't hold fixed income. What are we supposed to do? So.
Yeah. And so I think that's a beautiful segue, Zach. I appreciate you providing that excellent segue for us for, now that we've gone over where we've been. Bruce, do you have thoughts for us on moving forward and what that might look like for some of us?
Yeah, absolutely. How's my audio, Christina?
Well, we can hear you and none of us.
Okay, fair enough. So hi, everybody. So I kind of called this last month on our webcast. I felt like the mid-June was the bottom of the market. No guarantees, obviously, but it just felt like we were setting up at that point where a lot of the scared money had jumped out of the market, and further bad news didn't seem to freak people out as badly. I think a good example of that was last week when the 9.1% inflation number for June was reported. The market really didn't have a bad day that you would have assumed it would have. I think the market's been kind of, numb to some of these numbers now at this point. But inflation, it's kind of a plateaued area. Yeah, 9.1 was a new number, and that was certainly heavily driven up because energy prices had gone so high in June. But from March through, we're still in that kind of the same range. So going forward on inflation, what I expect is you're not going to see as high of an inflation number for July as we did in June. And, the real question the market is concerned about, and the market doesn't like uncertainty, and that's the uncertainty is the inflation and how much Federal Reserve action is going to take to get this inflation back into control. So I do expect a 75 basis point or 0.75% raise in the Fed rate in July. And I would expect to see a 0.5% raise in August. I think at that point, the Fed's going to take a pause, reevaluate what's going on, because you've got a lot of things that are going to fix inflation kind of without the Federal Reserve having to do too much. Part of that is the energy price and gas price being so high. And that's really the root problem of inflation, because energy, it goes through the entire economic system. So that's really what we're experiencing right now. So let's see what the Fed does. Again, we think we can get 0.75% raise in July, maybe a half in August, and maybe a pause at that point. And as soon as we see that inflation number heading back down, and the market and the economy believes it, you're going to see the market, jump pretty quick, or that's how I feel it's going to react to that. The supply chain is going to continue to be a challenge, but it is improving as we speak. We've seen some dramatic improvements the last few months in supply chain. Still, certain areas are going to struggle, but that is going to be an improved area as we go forward. Food is an area that I am very concerned about. A lot of farmers didn't plant as much and/or didn't fertilize as much this year, and then Ukraine, the war, that is causing some supply chain problems all to itself. So I would expect to see food continue to be relatively high, maybe not as much because of gas. I think the gas energy is starting to improve. We're seeing about a 60 cent per gallon improvement here locally, but we have more and more oil wells coming online as we go. But with that being said, I think food, all just because of scarcity, maybe a little bit higher price as we get into the fall, and really for the following harvest season. You can't just create food overnight. So that's going to be like a 1-year cycle once we don't have the normal supply at the fall harvest seasons. Unemployment, that's another area. And so I think David mentioned earlier, the overall fundamentals of the economy are strong. People are working, unemployment is low. Corporate balance sheets overall are pretty darn strong. We're just spending so much money so fast that inflation is high and driving things higher. Unemployment, I think you will see with the Federal Reserve raising rates, you're going to see some pullback in some employment sectors. Housing, for example, the builders' sentiment numbers came out yesterday, and that certainly is a lot lower than it had been before. Obviously so, because interest rates are higher. So the builders aren't as prone as of this month's survey to go out and spec build or, continue to be building at the pace they were. But we still are short 1 million housing units across the country. So it's still a shortage there, but the rates are going to slow the housing market down dramatically. And that is going to cause some unemployment in certain other areas, because they're not going to be able to borrow as much money on the companies that are more of a growth company to keep hiring people. You'll see a little bit of unemployment creeping up a little bit. I don't expect that to be a big problem, but you may see it get to 4.5% range. It's kind of a guesstimate there. Like I said, energy is looking better in the overall situation. It's hard to say that $4 a gallon plus is good, but compared to being almost $5 a gallon in the Midwest, it is a lot better than it was a month ago. So, that is going the right direction. We've got more oil wells coming online. That should continue to bring oil prices down and gas prices down, which will help inflation in the long run. The election cycle, and David touched on this, the election cycle years, by far and away, the majority of the election years are positive years, but leading up to the election, it's choppy. to borrow David's word. And a lot of times what this is caused by, and I don't care what side of the fence you're on as far as political leanings, if any, but each news outlet has their own preferred surveys that they like to report to appease their particular viewership. And so depending on what those surveys come out and what the timing of those surveys are, the market may or may not like that news. So you get a lot of volatility in the market, somewhat driven by election surveys. But by the time the election night hits, I believe it's November 7th this year, whatever the Tuesday election, early Tuesday election night is in the country this year. Once that happens, by far and away, that date forward to the end of the year is a positive on the market. And it doesn't matter if it's Democrat or Republican winning or doing what the markets are hoping will happen. It really doesn't matter. It's just the fact we have certainty at that point that part of the year goes forward. Another interesting statistic. So this is one of three, or there's only been three other times in history where we've had this bad of a first half or start to the year. And of those other three, all three of them ended up being a positive second half, and a pretty heavy number positive in the second half going forward from July 1st to the end of the year. Two of those three ended up more than recovering the first half losses and were positive years when it's all said and done. I've got the privilege or or problem of speaking alongside a lot of economists and with a lot of chief money managers. And so I kind of aggregate these thoughts together. And I was in a conference up in Canada not too long ago, and Brad McMillan, our chief economist, and several lead portfolio managers and other economists were in that conference. And without exception, everybody was feeling like we're going to have a positive year when it's all said and done. And some of them were even going out on a limb saying we may be a positive 8 to 10% on the year when it's said and done. I don't know. I'm in the camp that will be positive. I don't know if we're going to get that 8 to 10% recovery number for the overall year when it's said and done. But I do think we're going to have a positive second half of the year for a lot of reasons we kind of talked about. You just want to make sure that you're not jumping out of the market. One thing I like to make sure we coach our clients on is look at your holding screens on or holding section of your statement. A lot of people lose track of the fact that number they see at the last day of the quarter or the last day of the month that produced that statement, that number at that last day is just a temporary number. It's a snapshot of that one moment in time. And what you really own are the number of shares or units that you have. And you see that in the holding section of your statements. So I would implore everybody, if you're looking at your statements, look in the holding section. It'll tell you what the yield is of your investments, and it'll tell you what the estimated annual income is per investment that pays a dividend or yield. And then at the bottom of that section, it gives you that number. And unless you're taking money out, or unless you've dramatically changed your focus of your portfolio, your income estimates are going to be higher now than they were a year ago. And so that's what you really own. And your actual income has risen during this dip at a faster pace than it would have risen if the market had not dipped. And I think David or Zach had said that historically speaking, the market has always come back and recovered. And that's absolutely true. Question is how long is it going to stay down and how far it's going to go down. But these dips historically have helped wealth grow better when you stay the course, stay invested. And when we get back up on top, you've got more horsepower and more shares than you would have otherwise had. I think that's kind of as much as I have time to cover at the moment, but certainly reach out to us with more questions if you have some.
Yeah. Hey, real quick, we're gonna kick it on to David and Zach and Bruce. Any final thoughts on, as individual investors, how do we react to this information moving forward? I do have a question that got emailed in. And so I'm going to pick David to answer this, please, Mr. Pacer. There is an email question that prominent economists are pushing I bonds while the market is down. I think we can all relate to, we've probably all seen a few emails about that. David, what is your pro or con on whether or not investors should be adding I bonds to their portfolios?
I'm very favorable to I bonds. I bonds, again, are fixed income and they're paying pretty good right now because they're tied to inflation. But just keep in mind that those rates change twice a year. So just because they might be paying, say, 9% now, they could easily lower them to 4 or 5% this November. And you're limited to how much you can buy as an investor. It's $10,000 per year. But yeah, I think they're great. Now, if you're an extremely aggressive investor like me, that might be too conservative. So I think they definitely have their place.
So follow-up question, because I think this normally doesn't get discussed, and I think people should be thinking about this as well. If I buy an I bond today, how long do I have to own it before I can sell it back?
2 years.
Okay. So to your point, if interest rates get lowered, I'm still stuck with it for the rest of that 2-year time frame, right? Okay.
Yeah, but I mean, you have to look at that like anything else, right? CD rates change, bond rates change. So you just need to be prepared for that and just know what you're buying. That's all.
Perfect. Perfect. Thank you, David. So I guess with that, just moving forward, again, with this, Zach and David started us off with a little bit of the doom and gloom of where we have been, where we've all experienced that. And then Bruce comes in and tells us that really we should be cautiously optimistic moving forward. But as individual investors, I guess the $1 million question is just, what does this mean? Should I be making changes in my portfolio? Should I be talking to my advisor about XYZ action steps? Can you kind of help us out with some thoughts on that?
I can take that if that's okay. So quick 4 bullet points to this regard. If you have money available, it's a great time to add money, because even if we're not exactly at the bottom of the market, it's still certainly on sale compared to where it had been before. And if you're taking money out, I would caution to try not to take money out, or pause taking money out if you can. Or if you've got any big projects or wanting to buy something big, I would try and say maybe wait till prices get better and try not to sell anything that you've got right now that is at a down point. Christina, one strategy that you and I use with a lot of our clients is tax harvesting, and that's always a good idea if you've got an opportunity to rebalance your portfolio, maybe capture some losses in the process and tax harvest a little bit. And I already talked about the holding stream, just understanding your statement and what your real value is in terms of shares you have, and not panic on the number that is the estimate into the number. So I'd say add money, reduce withdrawals, and try and rebalance the tax harvest. But the one biggest caution is, do not, unless you've got some kind of dramatic life change, do not become less risk at this point. In other words, if you're a moderate investor, it's not the time to go to being conservative. It's probably a good time to become more aggressive if we are truly around the bottom range, which I think we are. But if you felt like this spring has been too rough for you and you're just panicking, stay the course for now. But when the market comes back up and gets back to previous highs, which we expect it to do, then it's a time to rebalance, become more conservative. But you don't want to lock in losses by getting rid of more of your equity at a down point. I'll kick it over to David and Zach.
Yeah, I mean, like Bruce said, let's turn lemons into lemonade, right? There are things you can do. And these are the 3 most popular ones that we're doing for our clients. If you're not clients, we encourage you to do these with your accounts. If you're not, or seek advice from us, we can help you. Rebalancing is a great time. Sell high, buy low. That's exactly what rebalancing does. But you have to have passion, right? You have to feel confident that you're selling something at a profit and you're willing to move that money and buy something that hasn't done well over the last 12 months. You need to take the emotion out of it. That is a proven strategy. Bruce touched on it, reinvesting dividends and interest. Your investments are paying more now than they ever have before. And if you reinvest those, you're buying more shares at cheaper prices. And then Bruce touched on tax loss harvesting. This is a huge opportunity. A huge opportunity. I can't tell you enough how important this is. And this is something that the government will let you do. So if you own an investment that is down in value, you can sell that investment. Take that loss on your tax return as a deduction. You can buy that same investment back 31 days later and still take the loss. So this is very common to do right now. Things are down. You never want to sell something that's down, right? We always encourage our clients not to do that. But this is a way that you can temporarily sell something, take the loss. If you want to stay in the market, that's a great idea. Just buy something else. If you own stock A and you want to sell it at a loss, buy stock B. That's very similar in nature. That way you're not out of the market. So wonderful technology, wonderful strategy to do in times like these.
Perfect. We've got about 4 minutes left. Zach, anything you'd like to add on to this point or previous points that we've had so far?
Yeah, no, I mean, I think both David and Bruce are spot on with a couple of the bullet points. And, I'd reiterate that, what we're doing, currently, I think I can speak for all three of us and all the other advisors in our offices. There's a lot of research going on and things that we've been paying attention to when we listen to economists like Bruce mentioned that, we're looking at valuations and PE ratios and things like that to look at what's been happening over the last couple of years and where we should position our portfolios going forward. So as Bruce, mentions, and I'd agree that we're kind of cautiously optimistic about where we're going forward, and maybe a reduction in the amount the Fed's gonna hike rates, or if we get some after the election, if we can kind of get some positive sentiment, what part of the markets are going to kind of lead us higher. So I'd say, at least in our portfolios, we're looking at a lot of things that PE ratios and valuations, while they've been a lot higher over the last couple of years, we're looking at those that have come back down into a more normal trading range, or even some that are trading now below kind of their historical averages, and we're kind of weighting portfolios according to that kind of thinking, and looking forward to be always looking forward through the windshield instead of backwards as to what's going to drive the market higher. Like Bruce mentioned, it's going to happen. It's just kind of a matter of when. So if you're not talking to your advisor on how we're kind of positioning that going forward, I know they have thoughts on it. Please ask how we're doing that, and we'd be glad, each one of us sharing kind of our own individual strategies and twists going forward. So
thank you so much. One question that came in from a 401k participant real quick, and it's the question is, I think all three of you are actually listed as advisors on this account, ironically, but the question is, if I have a 401k account that's in a model that's managed by Infinitas, so like maybe this participant is in the balanced model, should they rebalance that model, or does that already happen as part of the model features, or what does that look like?
Yeah, so a great question. The models will rebalance occasionally throughout the year. If they're wondering to know if they should change the risk level they're at, again, if they felt like they wanted to, and if their time horizon is long enough, they might want to step up to growth or even aggressive growth, but that'd be something they probably should talk to us individually from their specific situation. I definitely wouldn't rebalance it downward in risk, because at that point you give up some of your equities that historically have always rebounded with markets coming back up. So some of this stuff is automatic pilot as far as the model management in our systems, but if you're talking about your personal risk, again, I would stay the course, or maybe even get a little more aggressive at this time if we're truly close to the bottom, like I think we are.
I think, like Bruce mentioned, that's really just dependent on kind of the time frame and some of the things that you have coming up, over either it's a 5-year time frame or 10 or 15. That kind of helps us to guide the conversation to say, yeah, it definitely is appropriate and something that you can take advantage of to step up to that aggressive growth or growth model. But if retirement's maybe more around the corner, maybe that's something you don't want to do. There may be other strategies that we can kind of use to take advantage of this market. So to Bruce's point, please meet with us and ask questions, and we can kind of dissect that more personally for you all.
Yeah, so clarification, the question is not about whether or not they should change their risk level. The question is, we talked about how we're rebalancing portfolios on the private wealth side to take advantage of buying low, selling high, that type of stuff. The question is, if they're in a managed model through Infinitas at, say, Alaris or Fidelity or something like that, does that rebalance automatically happen, maybe every quarter, semi-annually, that type of question is what they're wondering.
Yeah, Bruce and I are both, on the team that's leading some of the investment changes, on the 401k side specifically. So yeah, we're looking at the funds underneath those, and also the allocations and updating those, just like we would. We spent a little bit of time today talking about private wealth, so it's a great question that, we're doing the same thing on the 401k side, and that will happen, for you if you're in that kind of model portfolio. So the changes that we're making behind the scenes will happen for you. And I think typically there's a semi-annual rebalance that, is pretty common, that happens, throughout the year, not specific to the changes that we're making specifically, sector to sector or specific allocation wise.
Perfect.
I do
Perfect.
know that each plan will give you the option as the investor where you can go in and choose how often you want your model rebalanced. Many plans offer that. Not sure if the person asking the question has that, but I would definitely check the website or seek advice from us and we can help you determine that.
Perfect. All righty. Well, Zach, would you mind popping up that slide where individuals can go for further questions moving forward? We are right at 12:31, so I want to say thank you all so much for your time this afternoon. We're so happy that you could join us. We will stick around for a few moments to answer questions live. If you'd like to unmute yourself and answer a question or ask a question, excuse me, in front of the group. You can also email questions to me directly, and I can forward them to the appropriate panel speaker if you'd like them to answer a question that you want to ask individually. Again, thank you so much for joining us. We really appreciate everyone's time, and we hope you all have a great rest of your day.
Thank you.
everyone.
I'd like to also add that, the four of us had the privilege of speaking on behalf of all the Infinitas team and advisors. And I think we have somewhere around 60 people all on Infinitas and 25 plus advisors. So we just had the privilege to kind of speak on behalf of the Infinitas group today. But there's a lot of great advisors in Infinitas, so certainly reach out to your individual person for specific comments if you need to.
Sorry, I was on mute. I was complimenting your moderating, Christina. Well done.
Yes, very good.
I like to be in charge of y'all. So it looks like there's a question, Zach, from a gentleman named Jeff. If you can.
Yeah, thank you. I'll be the first to ask a question. I forgive me if I missed this earlier, but what are your thoughts around, fighting inflation in terms of investment being allocated towards, I don't know, gold, commodities, things like that to fight inflation?
I can take that if you guys want. Gold, ironically, has not really moved this time, which has kind of been historically different. Usually when the market's not doing well, it's unsettled and a lot of uncertainty, gold usually rises. But really haven't seen that this time. Again, yield is one of your best ways to take a silver lining, or as David said, make lemonade out of lemons, because you're gaining more shares at a cheaper price. But this has been one of those weird times where it really hasn't been a safe harbor. Bonds pricing has been down all year long, which that's pretty typical in a rising rate environment. A lot of the things that you think, well, inflation, what can you do about it? A lot of things have already been baked in and priced into things that you could have done, I suppose, 6 months to 12 months ago, if you would have known for sure that this inflation was here for real and if the Federal Reserve was going to raise rates or not. So a lot of things is almost a little bit too late to the party to take any dramatic changes right now. And we're kind of at that, like I said, I feel like we're at the bottom of the market right now. I really think we hit the bottom last June or last month. And at this point, I think the best place to take advantage of this overall situation is probably stay in the equities, maybe even go a little bit more upscale in how much market you have if your risk tolerance and time horizons are correct for that. I kind of think we've seen the worst of it. And again, 3 out of the last, going back to the 1930s or the 70s and 30s and one of the time frame where we've had this inflationary environment and or had a really crappy first half of the year, the market has 100% of the time had a really good second half of the year. And 2 of those 3 times it more than made up for the first half drop. So if we're accurate, and if I'm accurate, I don't want to speak for everybody, but if I'm accurate, and if the bottom of the market was last month, then probably the best thing you can do right now is stay the course in equities, or maybe bump up a little bit in the equity side. David or Zach, you got any other comments on that question?
Definitely been a strange year, right? With inflation, normally precious metals, commodities, energy, that all does well. And commodities have been a very strong category to be in up until June, right? You've given back 20% of your gains over the last 30 to 45 days, but gold's down. It's very strange. It's different in that regard. Treasury inflation protection securities, TIPS, in other words, tied to inflation, also down. So what has worked in the past is not working this year. So like Bruce said, I'd stay, hold the course, keep your equities, because they're going to bounce back eventually.
Thank you for the question. Appreciate that. Any other questions at the moment that you'd like to ask in front of the group? I'm not seeing any other raised hands from participants, so I think we may be good. Again, if you think of any other questions, feel free to email me at any time. My email address is there on the screen. It's Christina with a K at infinitoskc.com. I would be more than happy to connect you with one of these panel members or your individual advisor. If you'd like to reach out to them, you're more than welcome to do that as well. Again, thank you all so much for your time. We really appreciate it. Thank you, Zach, David, and Bruce for speaking with us this afternoon, and hope you all have a great rest of your day.
Yeah, thank
Thanks
you
a lot,
for having us.
everybody.
Everyone,
Appreciate it.
have a good week.
Thank you.